Hey, good morning. Good morning. This is Julie. I want to do a chart review and go back through time. Trip the Light's fantastic, if it were, and go back and look at some of these excursions outside of the daily 1, 2, 3. So this is a 30-minute chart of the E-mini S&P 500, and on the top boxes, the initial inside range are your PT1, 2, and 3 up and down. Price normally stays inside the 1 in a normal distribution, and when price leaves the 1, it will go to the 2 and the 3. Sometimes it'll leave the 3, and I put tails on above and below my distributions now, so I can go to the area that will be the next target to hit, like the algos do, up or down. And when you purchase options, you're looking to hedge a position for your stock or for your portfolio. If you have a long only portfolio, you're trying to hedge the downside tail risk around OPEX or expiration. And likewise, you'd probably sell an opposite call and hedge that. So you can lose your tails up or down. And the key I found out yesterday is not you won't lose if it just touches the line and comes back in. And a lot of the times that's the behavior you'll see is it may touch the line because the algos, that's their target. They trade to the target, get paid, and then they go back in. Um, get paid meaning getting the most bang for their buck, and then they let it go because they reverse it. So that'll be your stop and reverse. So your stop and reverse is here, this first tail. And occasionally it'll get past your first tail to the second, but very rarely does it go below the second tail. If you are hedging, you need to know, if it closes below that first tail, you most likely are going to try to roll your debit or credit spread to the next day's distribution. And a high probability trade is if it does leave the first distribution, or your distribution here, like on December 3rd, the high probability is that the next day distribution will not be challenged. And this will act as support resistance, and the market moves back up in line with the overall long direction that we're in with those JP Morgan um, options that are being placed in the market, that the market tries to trade to. That JP Morgan trade is going to be expiring, that long only trade. Keeping the market long only is going to expire December 31st. So we'll see if they roll that again. It's been challenged in 2 months. And I'm going to show you both of those months. It was challenged in November and in September. So here is another example of it touching the line and bouncing. That next day did not get challenged, but we came back the day after. So again, you would roll to the next day and it didn't get challenged. Here in November, we lost our lunch twice. So this day, the first day of the OPEX, really got challenged. And I can put a second level of fibs on to get down to those lower strikes. Right here. So it blew through my first level. So you were rolling to this next day. And as you see, the next day rule was enforced. So those rolls were enforced this next day. But the day after, it got challenged again. So they came back, tried to get back. They pinned them at this one. Do you see that? Nothing got past this one. So the next day challenge could never get past the PT1. They pinned the market. It was like hitting a brick wall. Nothing was getting through. But then they let the pin go and it came back down even further. And here's the bad thing that happened in November. It broke it again. It broke it again on December 1st. So I think this was a wake-up call for a lot of people that next day rule did not work. Now it didn't close below it, but it came damn near close, right? And this is the one that sent the market back up. No, here, over here. This one. The next day rule was enforced, and then they tried it again, bringing it back down. So the market has been trying to short, short, get short, and so far they've been managing to hold water. I don't know how long they'll be able to play this game, but right now it's still working through the end of the year, December 31st. Some people, I talked to a trader yesterday who thinks that January 1st of the year might be very bullish. I agree because you're going to have those fiscal spending policy packages coming out, and so that's going to be very good for the equities. But as far as these put call hedges, the wheels are coming off the cart. Here's a breach, did not close below it, went back up, next day held, and if we go back, see everything is inside the ones until that expiration. Here we go. September, broke through, next day held. You got to the second level in September. Let's keep going, look at July. Here was another September. This was a big one. It went to the second level. So this September one went all the way into the second level. It never got to the bottom one. Remember I said I've never seen it get to the bottom one. They stop it at this second one, and I've got these levels. I know what they are. It's like, Ricky, I've got your number. I know what it is. I have it. It's right there. Send it back up. Otherwise, inside the ones, inside the ones, inside the ones. First fib held. No threat the next day. Well, excuse me, let me back up. August. Here was a double dipper, triple dipper, triple dipper. So, wow. Okay, so we broke through in the August OPEX. So maybe August started it. Of what year is this? Yeah, 21. Got to the third level and broke it the next day. So that roll on the next day lost. They lost their shit this next day and they had to roll it again. And it broke through again. So this was a triple dipper. It never closed below the first line. So any close below my first level would probably lose. Um, and they lose money by having to extend their hedges out. They try to put them in as close as possible in order to get paid doing those ratio spreads. But paid the most, I mean. But you can see on these bottoms this long vol coming in. on these bottoms, getting them up and out of these areas. Um, so that was a triple roll in August. So the wheels are coming off the card. Otherwise, in the middle, in the middle, in the middle. Here's the July. Broke through the first part of it. Didn't get to the second level of my fibs. They pushed it back in, but the next day held. So that next day roll rule works a lot of the time, but we've seen that it is starting to fail. Um, Here we first part of July, July 8th, broke through ahead of OPEX, so I wonder what that was about. Next day held. So a good rule of thumb is when you break into the tails, go long the next day. I mean, the pattern, if it keeps holding, now that I'm posting this on YouTube, it probably won't hold, but the pattern tells you that you really do want to try to position long anytime that tail breaks. Here's June OPEX. Got it a little bit below the 1 into the 2, but it never failed. Went right back up. Otherwise, in the middle, 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 in the middle. And here's May. Same thing. This is the normal. Well, there's a 2-day. So here was a 2-day, well, actually a 3-day roll in May. So here's another triple roll. Did not breach the first level. So maybe it was just a 2-day roll because this one didn't breach. So this one breached the second level, but closed back above it. Do you see that? They got it back inside the time. I'm looking for the timestamp. 10:30, 1300. Yeah, they were pounding that. Look at this high range expansion, they were fighting that tooth and nail to keep that second day roll alive. Anything, it has to be closed above the line. Remember, it can breach it, but they've got to get it back above the line. And then the following day, since this roll held, it broke again. And then this roll held. So that next day roll is a good rule. But I can see why they are nervous. We're breaking it mid-month in addition to OPEX. You're starting to see these mid-month breaches. April. So you get the idea of I'm looking at real volatility. I can see where the algos will come in and start hitting it hard. So this is a buy zone between 1 and 2. And I can set an algo to buy that and try to get positioned like the banks are to take this little piece of real estate right here, my risk and reward, there's my buy anything in here and then try to, oops, send it up, 1,000,000 points compared to my little risk. So that's what I'm interested in doing for good reason. Now, here it failed, went all the way down, and the next day rule came into force. So if you know the next day rule is going to be there, your stop is below the PT3 or that first fib for sure. But usually that next day rule comes into enforce, right? And they send it back up if they lose it. So it's getting wild and hairy on these. Oh, and here's a. They started front running it. It never got it. They got it down there, but they pushed it back in. So these range expansions into the tails are buying opportunities. So we need to take this down to a smaller time frame and see how to get positioned to go long at these areas and then hold those swing trades. Broke it, next day rule came into effect. So that's your pattern. Broke it all the way down to the second level in June. And then the next day rule, and then the day after, broke it again, came back up. So you're going to have a break, a pause, break, and then up. If it breaks twice in a row. But we did see that one triple one, but it's very rare. Most of the time the pattern will hold. So I've got the pattern. Maybe need to wait for a 30-minute candle up before buying. Just don't buy in the box. Wait for that candle to close in it. Close in that box or above and then get in. Now, on the other side of the mountain, here's another big trade day. Came right to my second fib level. And this was the December last year on OpEx. If it gives you any sense of foreboding, people are looking at this December pattern to try to repeat it. That was huge. That was December last year. Okay, so this year we started breaching these upside calls. So they hedge on the upside as well. And right now we're back in the middle of the range, but we ran out of room on the weekly. So let me change this to a weekly distribution and I'll show you the reason that we're out of room. And we hit that second tail and got above it. That can't happen, right? So it had to come back in. So we've got our weekly set up on the upper tail on the weekly. So if we look throughout history to see if it ever got to the third fib or higher on a weekly, let's go look real quick. Everything is inside, inside, inside. Look at that. It's just so here we got above it, but it never got above that first fib. That is your call hedge, that first fib line. Okay, here's one right here, but they sent it right back in. Or did it close? It looks like it got closed right on the line. So this daily, February 5th, that cost some people some money right there. A lot of money. Or would they have just rolled it to the next week? Maybe. They can roll these. I bet it's expensive. Somebody needs to explain this roll, but that got breached. But not does not happen hardly at all. Tried to get up there and came back down. And here's a big breach. Okay. So here was a big breach. November of 2020. Broke through 1, 2, 3 levels, came back in the third level. Or actually, it hit the line on the third level. So this was November of 2020, a big breach to the upside. Um, so they must have to do the same thing. If you get threatened at that first fib, you just roll your contract to the next week. Sell the premium here. Never hit it right here. This weekly held, came close, and that's all she got. So if you get close to this first fib on the weekly, you're pretty much out of headroom for any more upside. And that's what we're seeing today. We hit above that fib and they're having to send it back in. So these up moves are over in my imagination. 46.91. Anything above that, you're looking at uncle time. Okay? Capiche? So y'all let me know what you think of my indicator and looking at this real volatility with these bell curves and seeing the market for the first time fresh like the big banks do. And you can just see how they park the price inside these levels because that's where they're paid if it gets put in the middle, and they get challenged when it breaks out of that. But they're placing their fibs, I mean their hedges up here in the tails, and they're starting to get hit. Look at this one. That was the March, though. That was the pandemic. That was your pandemic. That's one that wiped everything out. Broke all of them. But you can see how these bottom ones were holding. So you can see that my levels are good. The market makers and algos know exactly where these levels are. It's amazing, isn't it? All right, all right. So, really good stuff. Fascinating. So, when they hedge, it's expensive to have to roll it, I guess. They have to adjust their position or take a huge hit. I need to talk about that and learn about it more and see how the dark pool DIX gamma whatever has to do with this, and um, get some more information from you option experts. But I appreciate your time. Hope you got something out of this, and just know that I know where the real volatility is. There's no doubt about it. I know exactly where these hedges are and where price is likely to fail and turn around. So I found the stop and reverse, and it is on my tails. All right, guys. We'll talk at you soon. Thank you so much. Y'all have a good day.